Welcome to our deep dive into arbitrage, an essential concept in finance that can seem elusive, but is actually quite straightforward once you grasp its core principles. Today, we'll explore the mechanics of arbitrage, dive into real-world examples, and analyze data to understand its effectiveness. By the end of this video, you'll have a clear understanding of how arbitrage works and how it can be applied. Let's get started with the basics. Arbitrage is the simultaneous purchase and sale of an asset in different markets to profit from an imbalance in the price. The key here is that this is a risk-free profit, as the transactions are essentially instantaneous. For example, imagine an investor noticing that Company X's stock is trading at $100 on the New York Stock Exchange, NYSE, but at $102 on the London Stock Exchange, LSE. The investor could buy the stock on the NYSE and simultaneously sell it on the LSE, making a $2 profit per share. This concept might seem simple, but it's the foundation of various complex trading strategies employed by financial professionals. Essentially, arbitrage ensures that prices do not deviate substantially across markets for too long, thereby maintaining market efficiency. To better understand, let's delve into three main types of arbitrage: pure arbitrage, risk arbitrage, and convertible arbitrage. Each has its own unique set of rules and examples to consider. Pure arbitrage is the traditional form and often involves straightforward transactions. Like our earlier example with Company X's stock, it seeks risk-free profit, the ultimate goal for any trader. Risk arbitrage, on the other hand, involves a higher degree of uncertainty, often referred to as merger arbitrage. It involves taking positions based on the potential outcome of a corporate event, such as a merger or acquisition. For instance, suppose Company Y announces it will acquire Company Z for $50 per share, but Company Z is currently trading at $45 per share. An arbitrageur might buy Company Z's shares at $45, betting that the deal will go through and the stock will rise to $50. Convertible arbitrage involves convertible bonds, which are bonds that can be converted into a company's stock. Investors may buy the bond and short the stock, profiting from the differences in pricing between the bond and the stock. To see arbitrage in action, let's take a look at some data. Consider a simple case of currency arbitrage involving three currencies: USD, EUR, and GBP. Suppose we start with 1,000 US dollars. Step 1. Convert USD to Euro. If the exchange rate is 1 US dollar equals 85 cents, we get 850 euros. Step 2. Convert Euro to GBP. If the exchange rate is 1 euro equals 0.9 pounds sterling, we get 765 pounds sterling. Step 3. Convert GBP back to USD. If the exchange rate is 1 pound sterling equals 1 US dollar and 35 cents, we get 1,032 US dollars and 75 cents. The initial investment of $1,000 has grown to $1,032.75, providing a profit of $32.75 from the arbitrage transactions. Let's visualize this example with a simple graph. Now, let's tackle a few common questions about arbitrage. Question: why doesn't everyone do arbitrage if it's risk-free? Answer: while pure arbitrage is risk-free in theory, in practice, it requires advanced technology, substantial capital, and timely information to execute successfully. Additionally, the profit margins can be very thin and can evaporate quickly. Question: what role does technology play in arbitrage? Answer: high-frequency trading, HFT, systems are often employed for arbitrage to capitalize on the smallest price differences across markets. These systems can execute millions of transactions in a fraction of a second. Question: are there risks associated with arbitrage? Answer: yes, particularly with risk and convertible arbitrage. Market volatility, changes in regulatory environments, and unforeseen corporate events can all impact these strategies. To better understand how arbitrage opportunities might look in real time, let's consider historical data from the cryptocurrency market, which is known for price discrepancies across different exchanges. Suppose we have Bitcoin trading at $40,000 on exchange A and $40,300 on exchange B. An arbitrager could buy Bitcoin on exchange A and sell on exchange B. Let's assume the following. Transaction fees on both exchanges are 0.1%, and the cost to transfer Bitcoin between exchanges is negligible. How much profit can be made if we trade one Bitcoin? Step 1. Buy one Bitcoin on exchange A at $40,000. Transaction fee equals 0.1% of $40,000 equals $40. Step 2. Sell one Bitcoin on exchange B at $40,300. Transaction fee equals 0.1% of $40,300 equals $40.30. Step 3. Calculate profit. Selling price, buying price, both transaction fees equals $40,300 to $40,000. $40 plus $40.30 equals $259.70. So, the arbitrager makes a profit of $259.70 per Bitcoin traded. To visualize, here's a bar graph representing the transaction process and profits. In summary, arbitrage plays a vital role in financial markets by exploiting price inefficiencies and ensuring consistent pricing across different markets. Whether you're dealing with stocks, bonds, currencies, or cryptocurrencies, understanding and leveraging arbitrage can significantly enhance your trading strategy. Thank you for joining us on this comprehensive look into arbitrage. If you found this video informative, be sure to like, subscribe, and hit the notification bell for more finance tutorials. Feel free to leave your questions in the comments, and we'll do our best to answer them. Until next time, happy trading!